Hi, I'm Tanja Hayes. Let's learn some economics. Today we're going to learn about supply and demand, which is a very basic but important economics concept that we want to make sure to be able to visualize and figure out what happens when these curves move around and stuff. So let's start from the beginning. What we do is we make a diagram that's going to have quantity and price on the axes. So we're going to be looking at quantity down here on our x-axis. And then we're going to have our price on our y-axis. And so we are going to relate those two, and we're going to see what happens. If the price changes, how does the quantity of an item change in terms of what do people want, what do the sellers want to do, and where do we end up? How much is being sold and bought? So we have two parts of this equation, so to speak. We have the consumers and we have the producers. So the consumers, they are the ones that are demanding the product. So they make up this demand curve. And if we think about price and quantity and consumers, if the price goes up, people are going to want to buy less. If the price goes down, maybe there's a sale, people are going to want to buy more. So there's this inverse relationship between price and quantity, and that's actually called the law of demand. As the price goes up, quantity demanded goes down, and vice versa. So on this graph, we'll have a downward sloping curve, or we'll just keep it a straight line to keep it simple. And so this is D for demand, but we can also remember D going down. So that's a little visual or whatever trick. All right, and then the other part of it all is we have suppliers, the producers that are supplying the good. And the law of supply says that as the price goes up, producers are going to want to produce more, or more producers are going to come in and want to sell this item because now that's more attractive to do. As the price goes down, fewer and fewer people are going to want to bother selling the product. So that means that price and quantity are related together in this direction. So as the quantity and the price go up, they are moving in the same direction. This is the supply curve, and it goes up, has a little up in itself. Love it. All right, so that's how that is set up. And then we notice there's a special place where they cross. That's called the equilibrium. And we can trace down here to whatever that quantity might be. We kind of start vague without any numbers, but imagine that these are numbers. This is like a number line going up in that direction. So there's some amount here. Whatever that quantity is, we can call that the equilibrium quantity. Sometimes we might call it Q star, we might call it QE to denote that that's the equilibrium quantity. And then similarly, we have a price at this equilibrium point, which is the equilibrium price. We could call it PE, P1, P star, whatever we want to call it. But this is the very special spot where if we are reading off the quantity demanded from the demand curve, the quantity demanded is this amount. And from the supply curve, whatever the quantity supplied is also going to be that same amount at that very price. So in this case, this is the equilibrium. This is how much is going to be supplied and demanded. And we tend to end up at the equilibrium if nothing else is done to this market. And there is kind of this idea of the invisible hand makes that happen. That's an expression. And let's see how that works. So let's say we had a high price. Let's call it PH for the high price. You can call stuff whatever you want. So I'm calling it PH. Let's say that's the price up here. The price is set really high. So what's going on here? What's the quantity supplied at that price? Well, we'll look at our supply curve and go down and say the quantity supplied is over here. It's pretty high. People want to sell a lot when it's that expensive. However, what's going on with the consumers from the demand curve at this price, the quantity demanded is not very high. People don't want to buy that much stuff when it's too expensive. So there's a mismatch between them. The quantity supplied is higher. And so this difference here, this amount, is called a surplus. So basically, it's kind of like looking at a store and they have a whole pile of stuff. Nobody wants to buy it because it's too expensive. So what would the store do? What would the producers do? Probably decide, let's lower the price, see if we can get rid of this item. So they lower the price. Let's say they go down a little bit to maybe this price. There's still a difference here between the quantity supplied and the quantity demanded, but it's getting smaller. So the surplus is getting smaller, but still some stuff is just sitting there, not getting sold. So let's lower the price some more. And you see what's going on here. We're going to lower the price until we get to the point of the equilibrium, where the quantity demanded and quantity supplied will be equal. So no more surplus at that point. So basically, even though there was no lawmaker coming in or a sheriff telling anyone you have to do this and that with the prices, it just happens on its own because that surplus is sitting there and automatically prices are going to go down until they get to the equilibrium. Similarly, if the price was too low, we would have a shortage. We would have the quantity demanded being higher than the quantity supplied. People would be rushing to the store to get this item and we would be running out. There would be a shortage. In that case, producers could, and so they would, raise the price because they're selling it anyway, right? So then they could raise the price until getting to that equilibrium. So automatically, if we don't interfere in the market, we will end up at this equilibrium. And that's all for this lesson. Thanks. See you soon.